Okay, so let's talk about the types of adjusting entries. Excuse me. So there's two different categories, deferrals and accruals. These are adjusting entries. And I know it's kind of confusing because we say accrual accounting, so you think accruals, you know, accrual accounting, but deferrals are part of it too. Okay. So under deferrals, we have two things that we can have there. Prepaid expenses. So this is something, it is an expense that you paid in cash and you recorded it as an asset before you actually consume it, right? That would be, you pay for your entire car insurance for the year on January 1st. You have prepaid 12 months worth of insurance. Then at the end of every month, you will do an adjusting entry in order to recognize how much of the insurance you've used up, okay? But when you actually, when the transaction actually takes place, and we've already done this, we debit a prepaid expense, prepaid insurance, and we credit cash when we buy the insurance policy, right? The second one is unearned revenues. So that means that we've received cash before we've provided a service. So we have a landscaping company, somebody pays us $5,000 in advance, that is unearned service revenue. We debit cash, we credit unearned service revenue. We are an NFL football team, people buy season tickets. It is unearned service revenue, and as every game is played, they recognize how much revenue they earned from that game. Magazine subscriptions, airline tickets, hotel reservations, anything that expires over time, okay? Anything that expires over time. Accruals, we have accrued revenues. So these are revenues for services performed but not yet received in cash. We've already been doing that. You provide a service to John Smith, you provide a tutoring service to John Smith, and he will pay you in 2 months. You debit accounts receivable, you credit service revenue. So we've already been doing that one, and you guys didn't even know you were doing it. Already been doing that one, okay. The next one is accrued expenses. We've already been doing this one too. Expenses incurred but not yet paid in cash or recorded. You received a bill for $500 in rent expense. You haven't paid it, right? So you debit rent expense and you credit rent payable. Or you buy inventory, well, we won't use inventory. You buy something and inventory. You debit inventory, your asset, you credit accounts payable because you're going to pay the bill later. Okay, so we've already been doing those two. Questions about any of those? We're going to look in more detail at each of these things. Just want to see if there's any questions. All right. So we're going to go through all of these ones, so you're going to see some repeated information on the slides.
Can you go back real quick?
Okay, yeah. Oops, I went back again. Okay. All right. So anytime you have a deferral, anytime it's going to be prepaid expense or an unearned revenue. So you'll want to make a note of that somewhere, kind of help you to figure these problems out. Okay. So prepaid expense could be prepaid rent, could be prepaid insurance. I think those are the common ones you're going to see. Unearned revenue. So that's unearned service revenue. You provide a service, or you haven't provided a service, but they paid you money already. Okay, so here are some examples. So adjusting entries for prepaid expense. So payment of cash is recorded as an asset because the service or benefit will be received in the future. So we're getting the cash before, or we're making the cash payment before the expense is recorded. So these are the common things you're going to see. that are going to have an adjusting entry around them. So when they actually occur, so you buy supplies, you debit supplies, you credit either accounts payable if you haven't paid for it yet, or you credit cash if you paid for it, or you debit prepaid and you debit insurance expense, or no, this is coming from the other side. I'm trying to think. Well, we'll look at the examples. It's harder, I think, to explain it that way. But these are the categories that you might have them in: insurance, supplies, advertising, rent, equipment, buildings. I'm trying to think if there's any other ones. Cash payment, report, expense reported. Is there anything else that? Okay, we can't think of any other ones, so we're going to look at these now. Okay, so these are things that the costs will expire over the passage of time or through using them. So passage of time would be things like prepaid insurance or rent. Using things up would be like supplies, because we're going to do an adjusting entry where we move stuff from supplies, the asset, to supplies expense as we use it up. Adjusting entry. Okay, so when you do the adjusting entry, you're going to debit an expense account and you're going to credit an asset account. So every single time you do an adjusting entry for a prepaid expense, that's going to be the rule. Debit an expense account, credit an asset account. So this is not when you actually pay the insurance. This is the adjusting entry you do every single month to recognize how much insurance you've used. Okay? So every single month you're going to do an entry. You're going to debit insurance expense. You're going to credit an asset account, prepaid insurance.
1 second.
It's a debit expense and credit asset.
That's the adjusting entry. And we're going to look at an example of that. Okay. All right, so let's look at an example of that. Maybe, oh, sorry. We'll click happy today. Can you tell? Okay, you ready? Okay. All right, so here's an example. So we pay $1,200 for a 1-year insurance policy. So what is the entry when we actually pay for the bill? We've done this one before. Pays are paid, right? Pays or pays means cash. Cash is an asset. Assets have a debit balance, and to make it go down, we have to credit it. So we know that's the second part, right? So for this problem here, when we initially do we pay the bill, we're going to debit prepaid insurance, and we're going to credit cash. So if we're looking at the T accounts, and this is something where the T accounts can be really helpful because there's something that you can go back to repeatedly to help you with this. So when you actually did the transaction initially, you debited prepaid insurance, right, for $1,200, and you credited cash for $1,200. Okay, that's when the transaction occurred. We've already done that in the past. Now to do the adjusting entry, you're going to take the amount and figure out how long it's good for. So this says it's good for a year, right? So what's 1,200 divided by 12 months? $100 a month, right? So we're going to have to do an adjusting entry every month for 12 months. So your adjusting entry, at the end of every month, you're going to debit insurance expense, $100, and you're going to credit prepaid insurance, $100. So what ends up happening on your T accounts is that I'm not gonna put all the T accounts, I'm just gonna put these two so you can kind of see what happens. So we have two accounts, prepaid insurance and we have insurance expense. At the very beginning, prepaid insurance has a balance of $1,200, right? Insurance expense has nothing. Every single month when you do your adjusting entries, what's gonna happen is your insurance expense is gonna go up $100 and this is gonna go down $100. So at the end of the first month, you now have an $1,100 prepaid insurance and a $100 insurance expense. And you're gonna do that every month, every month, every month, until pretty soon you have $1,200 in expenses. And over here, you're gonna go every month, this is the other side of the adjusting entry, until pretty soon you have nothing left in prepaid insurance. You've used up all the insurance. Does that make sense?
Well, we're gonna have a balance of 1,200 on the other side.
Not gonna
No,
say.
it's gonna be zero. 'Cause
Oh.
remember, to balance the account, you go 1,200 minus 1, 2, 3, 4, 500. So this would actually be, this right here would be $700 would be the balance. But you're gonna do it 12 times. So it'd be 1,200 minus 1,200 is 0. Okay, does that make sense? So this is where sometimes the T accounts can be helpful on scratch paper to help you figure things out sometimes. That's kind of an example of what happens. Now, in the real world, you know, there's lots of different adjusting entries, and how do you know, like, when do I do these adjusting entries? How do I know to do these adjusting entries? So just as one example, when I worked in accounting, my last like big accounting job, I had a folder for every month of the year. January, February, March, April, May. I had a folder in a file cabinet for every month of the year. And then I had one folder that was a master file. And so let's say I paid this insurance and I would go, oh, okay. So everything starts from a source document, right? In our class, everything starts from a paragraph in the book and the problem. But in the real world, you would get a source document. So we'll say that this is the source document for the insurance. So it would be for $1,200. So what I would do is I'd look at it and I go, okay, this is for 12 months. I would take this and I would make 12 copies of this. I would make 12 copies. And I would write January, or I would like on the front, I would put January, February, March, April, May. I'd put all the months on there, and I'd put a little box next to them. I'd make 12 copies. I'd put one copy in every single folder for the year. And then I would put this master in the master folder, okay? Because sometimes things are not used up in 1 year. This might be a 3-year policy. So I might have to do the same thing for 3 years before this is fully used up, right? So then I do this for everything, all the different adjusting entries, because you have all kinds of adjusting entries. They come and they go and everything. So then at the end of the month, when you close the books, you go through, you balance your T accounts, you do your trial balance, then you pull your folder out and you do your adjusting entries. I go through, oh, okay, here's a prepaid insurance. I need to do the prepaid insurance adjusting entry. I do it, I check off that month, I flip it over, I go to the next adjusting entry. I do all of my adjusting entries. Those are batched together, and that goes with the adjusting entry journal as the backup information. I go all the way through the year, and then at the end of the year, when I set up my next year's folders, I go to that master file and I open it up and I see this and I go, oh, this was for 12 months. The last one was due December 31, 2017. I can now throw this away. I don't need this in my master anymore. I pull up the next thing and it's like, oh, this is something I have to depreciate for 3 years. The first year I did it was 2017. I still have to do it for 2018 and 2019. So I would make the copies, set up the folders for 2018. Does that make sense? So you have to have some kind of source document to generate these, because these are manual entries. It's not like you just go to your computer and say, hey, do this. Now, you can set your computer up to automatically do these adjusting entries for you, but you have to set it up initially. Somebody has to go in the computer and say, here's this $1,200 entry. It needs to be an adjusting entry done every month, and this is how the adjusting entry has to be done. Okay. So that's just kind of a little example of how you might manage it. Okay. Any questions on what the adjusting entry would be for this? For an prepaid insurance. You think you'll see that again?
Yep.
Yep. You'll see it on your homework. You think you see it on a test? See it? You'll see it on a test. Okay. All right, next slide. I'm not sure if this is like particularly helpful. Some people don't like this. If it helps you, great, go with it. So when you have an adjusting entry, they're just kind of showing you the T account. So they're showing you how it plays out, but then they're showing you like the unadjusted balance. So that confuses some people. But the thing that you want to make sure you know is when you do the adjusting entry for prepaid expense, you're debiting an expense, you're crediting an asset. So remember that, okay? Excuse me. All right, here is an example. Sierra Corporation purchased supplies costing $2,500 on October 5th. Sierra recorded the purchase by increasing or debiting the asset supplies. The account shows a balance of $2,500 in the October 31st trial balance. An inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. You want to make a note of this. Whenever you get a problem that has to do with supplies, the number that you are looking for is how much you've used. Sometimes they'll tell you, you have used $1,000 worth of supplies. Sometimes they'll tell you, you started with 2,000, you ended with 1,000, you have to figure out the difference, which is how much you've used. So whenever you're doing the adjusting entries for supplies, the number you want is what you've used, and that's what you're going to do your adjusting entry for.
Was it supplies or inventory? Supplies or inventory?
Supplies. So here's an example. So they tell you the balance was $2,500 on October 31st before your adjusting entries. When you do the actual count, there's only $1,000 on the shelf, $1,000 worth. So 2,500 minus 1,000 means you've used $1,500 worth of supplies. That's what we're after, what you've used. So the adjusting entry for supplies is debit supplies expense and credit supplies. Supplies expense is the actual used up supply, and supplies just by itself is the asset. So you have $2,500 worth of pens on the shelf at the beginning of the month. At the end of the month, you only have $1,000 worth of pens on the shelf. That means you've used up $1,500 worth of pens, and you have to show it as an expense. Questions about that one? Do you think you'll see that one again? Yep, just be careful. Sometimes they'll actually tell you how much you've used, and you don't have to do any math. So make sure you're paying attention to what the number is. Okay, let's see. On October 4th, Sierra Corporation paid $600 for a 1-year fire insurance policy. Coverage began on October 1. Sierra recorded the payments by increasing or debiting prepaid insurance. This account shows a balance of $600 in the October 31st trial balance. Insurance of $50 expires each month. So how do they get the $50? It's the total insurance policy, which is $600. Up here, they tell you it's for a full year. So 600 divided by 12. So that tells you every month they're going to do an adjusting entry for $50. If after the first month they cancel their insurance policy, they're going to get a refund of $550 because they've only used up $50. Okay? Let's see, questions about that? Yes.
How do you calculate, like, when there's like, there's a fee, let's say, if they were to get reimbursed, like, the broker or the insurance company collects like cancellation fee, so you can't really.
Oh, so if they have a cancellation fee, so what would happen is you would move that to an expense. So you might, like if they had a $20 cancellation fee, you might move $20 out of prepaid insurance into insurance expense, like just like this entry here, and then the balance that would left in prepaid insurance would be what you get. Yeah. All right. Okay. So we are going to have an entire chapter on depreciation. an entire chapter, and you're gonna love it. But for now, we are gonna look at depreciation a little bit. We're just not gonna go that in depth into it as far as figuring things out. So depreciation is always linked to what they call a long-lived asset. So this goes back to the whole idea of recognizing an expense when it's actually incurred, right? So if you buy a car for $12,000 and it's going to last you for 12 years, you don't put all $12,000 into your first year of expense. You take that $12,000 and you divide it over 12 years. And every year you have a $1,000 expense associated with that asset. So these are going to be buildings, equipment, anything that you see like trucks or all that, that's all going to fall under equipment in this class. It would get more specific in the real world, but here it's going to all fall under equipment. Land is not depreciated. Generally, land appreciates, which means it goes up in value. Okay.
So like would printers and computers fall under
Yes.
depreciation?
Yes. Now, some companies have a depreciation threshold. So like they say, we don't depreciate anything under $3,000. So if they pay $1,000 for a computer, they won't depreciate it. But if they buy 50 computers for $1,000, they're going to depreciate that. They're going to depreciate all 50 of them as like a lot. One, you know, because that's 50 grand. That's a lot of computers, right? Okay. So companies report a portion of the cost of the long-lived asset, the expense during each period of its useful life. Depreciation does not attempt to report the actual change in the value of the asset. You're not doing this to say, oh, the truck's now only worth $5,000. You're doing it to link together the revenue you've earned from having that truck with the expense that it was incurred for having that truck in the same period. That's what the whole purpose is, to link that together.
If you didn't link it like that, would it be showing, would it be inaccurate income? Would you be
Yeah, so
reporting?
if you didn't link it like that, it would be inaccurate income. So let's say, for instance, you only had $1,000 income come in. Let's say you earned $1,000 that month, and you bought a truck for $10,000. And so you would just put $10,000 expense, right? You would have a $9,000 loss that month, right? 1,000 in, $10,000 out, you have a $9,000 loss. So that's not the way you want to do it. Okay, for Sierra Corporation, assume that depreciation on the office equipment is $480 a year or $40 a month. So they took 480 divided by 12. So what they would do every month is they would do an entry where they debit depreciation expense and they credit accumulated depreciation hyphen equipment. So a couple of things here. One, whenever you have a depreciation problem, there's two accounts that you're always going to have. What do you think they are?
The equipment and then the depreciation.
The depreciation expense and the accumulated depreciation equipment. These two accounts go hand in hand. So whenever you're doing your adjusting entries for depreciation, you're always going to debit the expense depreciation and you're always going to credit the accumulated depreciation. The key you have to make sure you get is the hyphen whatever it is. So if you're doing building, you're going to debit depreciation expense, you're going to credit accumulated depreciation hyphen building. If it's equipment, it's going to be hyphen equipment. I think this is the only two you're going to see is equipment and building. All right. Some of these problems, they're going to tell you it's $40 a month. Some of them, they're going to say you bought a vehicle for $12,965 and it's going to be good for 5 years. So you're going to have to take that and divide it by 5. And then if you're doing the entries monthly, you have to divide it by 12, right? Because you get it down to the yearly amount. And then if you're doing the entries monthly, you have to get it down to the monthly amount. Okay. So watch the dates real close on that. Any questions, other questions on that one?
I just want to look at it. So for depreciation, we credit,
Accumulated depreciation.
and then we debit the expense.
You debit depreciation expense, you credit accumulated depreciation, and then whatever equipment or building or whatever.
And it's only one T account for depreciation expense, right?
Yeah.
So,
In reality, companies have more than one depreciation expense. They probably have like computer depreciation, building depreciation, you know, things like that. But in this class, we're just gonna have one depreciation.
and we're gonna have many accumulated.
Yeah, but in here, we're only gonna have like building and equipment. I think that's all you're gonna see. And accumulated depreciation is a contra asset. So what that means is it subtracts from the asset. So when you look on the financial statement and it shows equipment, $12,000, right below it will be accumulated depreciation equipment, $1,000. So now your book value of that asset is $12,000 minus $1,000. That's the book value. Okay. All right. So this is kind of showing us this right here. This is how it would look. Showing equipment, $5,000 less accumulated depreciation, $40. So the book value is $4,960. Okay, so this next slide is in the book. I think this is a good example as far as something to have for your notes to kind of remind you of what it is, because it shows you prepaid expenses, examples, insurance, supplies, advertising, rent, depreciation. It gives you the reason for the adjustment. It gives you what the accounts look like beforehand, and then the adjusting entry, which is the key part, right? What you need to debit expense, what you need to credit asset. Okay, so we're gonna do some of these. So we're gonna do VE44, VE45, and VE46. So let me stop this.